Hi everyone, this is CA Hardik Thakkar, and in this video we are going to understand the concept of income from house property. Okay, so let me give you a bird's eye view of what is going to be covered under this chapter or under this head of income, and let us try to understand the basic format of how you calculate income from house property. Okay, condition 1. For you to be considering income from house property, there are a couple of conditions that you need to satisfy. Condition 1. There has to be a house property. There has to be a house property. Now it sounds very obvious, but you need to understand, and you need to understand why this provision was kept in this particular head. Okay, let's say I give a piece of land on rent and I received rental income from that. Okay, so any rental income that you receive is not your income from house property. It has to be from a house property. What is a house property? Anything with 4 walls and a roof can be termed as a house property. Whether it is a commercial property or a residential property, but if it is a house property with 4 walls and a roof, then it can be considered as income from house property. So condition 1, there should be a house property. Second condition, the assessee has to be the owner of the house property. Only then your income can be under income from house property. Okay, I will give you an example. Let's say I take a property on rent at 20,000 rupees per month. Assume that you are the owner of the house property. You give me your property on rent at 20,000 rupees per month. Okay. Now I, being a smart businessman that I am, I got someone who is ready to take the same house property on rent for 25,000 rupees. So what did I do? I sublet the house property which I had taken on rent from you. Okay, so now that person is paying me 25,000 rupees, and out of that 25,000 rupees I am paying you 20,000 rupees, because the rent that both of us agreed is 20,000. So here, if you understand, in this entire dynamics, two people are earning income. Okay, you are also earning income and I am also earning a rental income. Both of us are earning rental income. But for you, it will be an income from house property because you are the owner of the house property. But for me, it will be an income from other sources and not income from house property, because even though I am earning income by renting the house property, I am not the owner of this property. Did you understand this? Yes. So there has to be a house property. Assessee has to be the owner of the house property, and the nature of income should be a rental income. Okay, if you earn income or profit from selling the house property, that is covered under separate head of income. That is not income from house property. Okay, that is covered under separate head of income, which is capital gain, which we will understand in the upcoming video, right? So income has to be of a rental nature. If you have understood these three things, okay, you know which type of income will be considered as under this particular head of income. Now, how do you take a format and how do you calculate the income from house property in a chronological order? Let us try and understand the format. Okay, so you start the calculation with the municipal value. Now, what is the municipal value? It is the value of your house as per the stamp duty records that is there in your locality. So that is a municipal value. You compare municipal value with the fair rent that is prevailing in the market, with the fair rent that is prevailing in the market. You compare, you take a higher of 2, right? You take a higher of 2. Compare that amount with the standard rent. Compare that amount with the standard rent. Now, what is the standard rent? Standard rent is a rent that is mentioned under Rent Control Act. Okay, so the higher of A and B will be compared with the standard rent, right? And the lower of the two amounts will be taken as your reasonable lettable value or your expected rent. So take the higher of municipal value or fair rent, take that amount. Okay, now forget municipal value and fair rent. Compare that higher amount with the standard rent. Take the lower of these two amounts. Okay, the lower of these two amount is your reasonable lettable value or your expected rent. Compare that expected rent. That means this is the minimum amount of rent that you should have charged for your property. Because sometimes what happens is that if the reasonable letting value of my house property is 20,000 rupees per month, what I will do, I will enter into an arrangement with the tenant that you pay me only 5,000 rupees in my bank account and 15,000 rupees you pay me in cash. So I will show that, yeah, I am showing my income as rental income, no, and I will pay whatever tax is payable on that. But my income is in fact 20,000 rupees, but I am only disclosing 5,000 rupees. Right? So to avoid such situations from happening, income tax says that I will consider a reasonable rental value of your house and I will compare that reasonable value with the actual rent, and then whichever is higher among the two, that amount will be taken as a gross annual value of the property. So if your actual rent is only 5,000, but if the reasonable rental value of your house property is 20,000 rupees, we will not tax you according to 5,000, we will tax you according to 15,000 rupees, we will tax you according to 20,000 rupees, sorry. If 20,000 is the reasonable rental value and 5,000 is actual rent, you will not be taxed on 5,000, you will be taxed on 20,000 rupees. That will be your gross annual value. From that, you deduct the municipal tax that is paid by the owner, okay, irrespective of the year. If you have paid any municipal taxes in that year, be it of current year, previous year or next year, it doesn't matter. If you have paid municipal tax, you can claim it as a deduction. You reduce municipal tax and then the amount that you get will be your net annual value, NAV, okay. After NAV, income tax allows you two kinds of deductions from your net annual value, okay. The first deduction is a standard deduction which is allowed at 30% of NAV, okay. So whatever your NAV is, take 30% of that, that will be reduced from your NAV, and you can reduce one more amount which is your interest on borrowing that is taken for the house property. Okay, if you have taken loan to acquire the house property, whatever interest component that you are paying on that house property, that will be allowed as deduction, and whatever income remains or whatever amount remains after that, that is your net income from house property. Okay, this entire calculation will be done for a specific kind of property which is called as let out property, that is LOP, or deemed let out property, that is DLOP. Okay, there is one more kind of property classification which is called as self-occupied property. For self-occupied property, there will be no calculation of any sort, only the interest on borrowing is allowed to be claimed as a deduction, and that too a maximum of rupees 2 lakhs. Okay, so from let out property you do the entire calculation, from self-occupied property you only reduce the interest on borrowing, and from deemed let out property every calculation will be done similar to let out property except the actual rent. Okay, now I'll take few seconds to make you understand what is the meaning of deemed let out property. Okay, the word deemed means it is assumed that it is let out. Now it might be given on rent really, or it might not be given on rent, but income tax by default will assume that this property you have given on rent. Now what is this concept? Okay, why income tax assumes that? Because income tax says that I can believe that there can be two house property used for residential purposes. But if an assessee owns more than 2 house properties, then if you have 5 house property, you cannot claim that I live in all the 5 house properties. That does not make sense, right? So income tax says that you can have 2 house property which you can claim as self-occupied, and any house property in excess of 2 will be considered as a deemed let out property. So if you have 3 house property, one of them will have to be assumed as let out. Now the good part is which property should be considered as let out, that choice lies with the assessee. So ideally the house property with the lowest NAV will be considered as a deemed let out property. So I hope you understood the basic concepts of income from house property. The practical part of it we will be covering in the upcoming videos, but I hope you have understood whatever we explained till now. Okay, so thank you so much for your time and attention, and I will see you shortly in the next video. Thank you.